To our top story this half hour, however, markets are closed, but we are open for business. The futures are trading, although the markets will not open at 9:30 a.m. Eastern Time. And we have some pressure across the board. Joining us now, Bulltick Capital Markets Head of Global Research, Kathryn Rooney. Vera. Kathryn, thank you for taking the time to come on this morning. It's been a great run for the markets heading into the new year after what was a really, truly awful fourth quarter. Can this continue given all the headwinds, whether it's the trade deal and the government shutdown?
Well, Dagan, you're right, and the fourth quarter was a great time to accumulate positions, and that's what I've been recommending to my institutional and retail clients is precisely that. Go long emerging markets, go long the U.S. S&P. I think that right now what we're pricing in, or what the market in the fourth quarter, Dagan, was pricing in, which was effectively Armageddon for the markets because of trade war, will turn out to have proven to be an opportune moment to go long a market where we have economic strength, regardless of the narrative that we're hearing in every facet of the media. It seems to me that recession is imminent. Recession is not imminent, and I do think we're going to get some form of trade deal that's going to send the markets higher.
Hey, Kathryn. Good morning. It's Mitch. The thing that concerns me about emerging markets is not all emerging markets are the same. So when you say go long emerging markets, are there pockets that are less risky than others right now?
Yeah, there's the MSCI Emerging Markets, which is basically the index, which looks at a broad spate of EM. So it's China, it's India, it's Brazil. All of these countries, I think, have been disproportionately, well, some more than others, you're right. But Brazil, for example, has been beaten up severely. It was a great moment to go long in the fourth quarter. We're already up double digits from October of last year. So certainly some countries are more beaten up than others. But I would contend that China will prove to be an interesting and appealing place to do business because of the trade fears.
So, Kathryn, Deirdre here. The IMF just publishing this now. They're actually cutting their global growth forecast, and then particularly in China, actually projecting it's going to be weaker than even the print that we got this morning. So they're saying in 2019, 6.6%, 2020, 6.6%. So do you feel like China is going to inject more stimulus? Is that why you're a little bit more bullish?
Yeah, well, China is a very interesting story because they have the social contract, and it being a communist country, while people are still repressed with regard to their ability to access certain internet pages or anything like that, the restrictive nature of living in the country requires that they have to be given something in return, right? So if the unemployment rate is low, things are okay. If unemployment starts to tick up or economic slowdown is more aggressive than was otherwise expected, then the government starts to get worried. So that's where we are right now. I do expect fiscal stimuli. I think it comes in the first quarter. I would even think that monetary is in the cards as well. And remember, China has been slowing for decades. China has been slowing for some time, and it's actually an orderly slowdown in the sense that they've been trying to become a global economic geopolitical superpower, which means changing their economic fundamentals from one based on, we all talked about the ghost towns or the roads to nowhere. So one based on state government spending to one based on domestic demand. So that's been a coordinated effort. Now I think that the stars are aligned, Deirdre, and I would say that incentives are aligned both for the Chinese and for the United States to come to an agreement, albeit small, with regard to trade.
So talking about that agreement, I mean, what elements of that agreement, what are you guys looking for on the market to say this is a good agreement, this is a green light for us to put more capital in? What do you want these trade negotiators to agree on that would get the market excited?
Well, I think, Richard, that the joint ventures, allowing joint ventures between U.S. companies and Chinese companies in China would be very clutch. We've already seen some concessions from the Chinese, which I think are a goodwill on the negotiating table to say, okay, we're actually in this to do something. Of course, the question that I always get is execution risk. But I do think that, again, the incentives are aligned for the Chinese to give something to come to an agreement with the U.S. so that the deceleration that was already in the cards is not aggravated further. So what I'm looking for is, we've already seen a reopening of imports to U.S. cars, a decrease in the tariff from 40 to 15 is excellent news. As well, I would like to see a real crackdown on IP theft. This is something that we've been seeing, as you would know, from Bill Clinton days, right? The U.S. really complaining about the IP theft. And we've seen some concrete punitive measures that the Chinese have put forth on their own companies that engage in this type of theft.
I think intellectual property is going to be the biggest part of these negotiations. That's a big elephant in the room. If we can get intellectual property taken care of, the rest of the stuff becomes easy.
Right. And
I would agree with that.
And Kathryn, that would get all investors excited. Just really quickly, what are you underweight here in terms of sectors or asset classes?
Look, Dagan, I think Europe is really not the place to be. I liked Europe last year because of valuations, purely because of valuations, because the U.S. looked very rich and Europe looked very cheap. Europe hasn't done their homework. We don't have any structural reform, whereas with their competitors, in terms of market competitors, we have the U.S., tax reform, deregulation. Japan, we have corporate board governance reform and increase of women in the labor force, which they desperately needed. So when an investor is looking at where to put money in developed markets, they shouldn't look at Europe because valuations are no longer attractive. And U.S. valuations look far more attractive.
The Eurozone's economy, broadly speaking, is slowing to the point that the European Central Bank, short-term interest rates are negative, and they were trying to raise them to get them back to normal. And now people over there are talking about they're going to keep the deposit rate at the current level till at least the end of 2020. That you're going to have negative rates till 2020, which is again, almost unfathomable. Exactly. Kathryn, Rooney, Vera.
But Dagan,
finish your thought, Kathryn. Go ahead.
Well, Dagan, I was just going to say that's an opportunity I think that should be of interest for investors over the course of the next year. Let's look at European banks because once, Dagan, they lift that punitive, it's a tax. It's a tax on banks. So once they lift that eventually, which they will do, then you're going to see banks fly in Europe.
But I might be collecting Social Security and on Medicare by the time that happens, given the...
That's true.
It's not that far off, but it's far enough. Thank you so much, Kathryn, Rooney, Vera. Take care.
Thank you very much.